Good evening, professional colleagues. Good evening, friend of the Institute of Chartered Accountants of Nigeria. Our students, we want to welcome you to another insightful and educative time. This day, Thursday, the 5th day of the month of January 2023. Let me state this, that this is the second edition of ICAN on Air. And like I said, we are fully prepared. The editorial board are out to make sure that we give you a very insightful moment every Tuesday and every Thursday. Like I keep reminding you, make sure you get someone on board. Don't just be the only one that will benefit on this, as we are always there to equip you with the requisite knowledge that is expected. Today, I have come with a topic that is very interesting, and it's very into both the professionals and the academics, and that is IAS12, bordering on income taxes. And I have no other person to do justice to this today other than Mr. Samuel Joseph Okoye, popularly called O.J. Samuel. He has 18 years post-graduate and professional experience, which cover banking operation, credit, retail management, international banking, foreign exchange, treasury management, operational information technology, finance control, tax, research, trading, to mention but a few. And he has worked in several banks to actually buttress his experience, spanning from the UBA PLC, the Continental Trust Bank, the Intercontinental Bank, and Bank PHB. He was the pioneer financial controller of the Bank PHD BDC Limited, where he was seconded by Bank PHB then, and directly responsible for the managing of assets worth over 3 billion at age 30. That was at 2010. He from there moved to Charm Consortium, a government concessionary, and he was the pioneer CFO to take the financial leadership. He is a chartered accountant and a chartered tax practitioner by academics and by professional. And he has so many qualifications to his credit. To interest you, he is a great author, and he has written over 10 pioneering publishing books in the area of accounting and taxation, witnessing massive patronage among professionals across Nigeria, English-speaking African country, and meaningful patronage in some other North American and Europe. He is a member of the Chartered Institute of Taxation of Nigeria, and also a member of our great institute, the Institute of Chartered Accountants of Nigeria, since 2009. Currently the Chief Executive Officer, Immaculate Metrics Plus, and the Managing Director, O.J Inspiration Limited, based in Lagos, Nigeria. I can tell you for free that our guest is well loaded and is out there to make sure that he gives us the best on IAS12, income taxes. Like I keep telling you, this is the best place to display your goods and services, because we have the global audience, and we are out to make sure that we get the best for you, to make sure that your product and services cover a wide range. On that note, I want to proceed on a very short commercial break, and when I'll be coming in, I will come in with a guest as we do justice to the topic of today. Please stay tuned. I'll be right back. Welcome back, welcome back, welcome back. And I have with me in the studio today on ICAN on Air, O.J Samuel FCA. O.J. sir, good evening and welcome on ICAN on Air this evening.
Yeah, thank you. Good evening, Mr. Shekson Kwade, for having me. I want to thank our institute, the Institute of Chartered Accountants of Nigeria, for finding me worthy to be invited for the second edition of this program for the year 2023. Thank you, media team. Thank you, everyone, for giving me that honor and privilege to be here. Thank you very much. I'm delighted.
Yeah, we're great to have you. And without wasting time, we move straight to the business of today. And we are talking on IAS12, which borders around income taxes. Let me start this way, OJ sir. Today, we are looking at tax, one of the mechanisms through which government seeks to realize some of the economic objectives. And the global viewers are happy to have you considering going through your profile, your position in terms of taxation. Though our emphasis will be on international accounting standard 12, that is IAS 12, which borders around income taxes. We are going to look at tax in general in line with IAS 12. What is income tax and what makes it unique or different from other taxes?
Okay, thank you so much for this wonderful question. Straight to the point, in line with IAS 12, income taxes are taxes levied or charged on profits, gains, and income. That is what income tax is about. It's about taxes or a tax charge on profits, gains, and income. Now, a little different from your consumption or expenditure or realization taxes. Now, the focus of IAS 12 income taxes is to prescribe how tax information concerning those taxes levied on profits, on gains, and income are to be measured and reported in financial statements. So the focus of IAS 12 is not about indirect taxes. Like you're talking about your value added tax, you're talking about your consumption tax, you're talking about your customs duties, your import duties, export duty, excise duties, and other consumption-based taxes or product-based taxes or service-based taxes. Rather, the focus of IAS 12, are on those set of taxes. You talk about your personal income tax, for example. You think about your company income tax. You talk about your tertiary education tax. You talk about even your information technology development levy. You talk about your Nigerian Police Trust Fund levy. So this category of taxes, petroleum profit tax, if you want this category of tax I've just mentioned, they are taxes levied on profit, on taxable profit. So that is the focus of IAS 12. So it prescribes how all these categories of direct taxes are to be measured and reported in a set of financial statements.
Great.
So we just want to contrast that as against what we have for indirect taxes, which are not the focus of IAS 12. Thank you.
That is great. And a better way to start the show with O.J. Samuel talking of IAS 12, which borders around income tax. We'll move forward. And like I always encourage our audience who are connected globally, I guess let me tell you, we are connected from the north to the south, to the east and to the west. And above that, from the diaspora who are ready to tap from the knowledge, the wealth of experience that you have. I proceed, Ojesa. What are the basic concepts of income tax? And please run us through the basic principle for accounting for income taxes under IAS 12.
Okay, thank you so much. You see, under IAS 12, it recognizes there are two categories of tax reporting that are required, two categories of tax reporting that are required. We have the current tax reporting required. We have the deferred tax reporting required. When it comes to current tax reporting, the prescription of IAS 12 is that certain category of information concerning your income taxes are to be measured, right, and reported in a certain way. So, for example, we talk about our company income tax, which could be 20% for medium-sized company or 30% for large company. Then we have, of course, the 85%, 65.5 this percent for for companies in oil and gas, depending on the fiscal framework, the upstream companies involved in and all that. So the question is, how are the tax information, how are the various sets of tax information associated with this kind of taxes measured? How are they presented in the financial statement? That speaks to current tax part of it. The current tax information and current tax reporting aspect of this tends to provide information to a user or reader of financial statement or to an investor as to the current tax obligations or the current tax benefits or the current tax assets, that are associated with the transaction of an entity as at a reporting date. So current tax deal with all those income taxes which have direct bearing on the profit gains on tax as at a reporting date in the present time. But deferred tax focuses on certain implication. You see, under the accounting framework and the tax framework are not the same. What do we mean by this? You see, the accounting framework with their standards that prescribes how assets are measured, how assets are classified, how assets are presented, and the likes. Under the tax framework are governed by laws of a jurisdiction. In Nigeria, if you are talking about company income tax, right, you talk about the Company Income Tax Act as amended by the Various Finance Act. And as you know, we have the small companies, medium-sized company, and large company. Now, staying with the medium-sized company and the large company, the law prescribes how total profits or taxable profits are to be computed. You will discover the part with which certain assets are measured under IFRS, for example, or under a given accounting framework, is not always the same with the way such item is measured for tax purposes. Let's take a typical example. When you buy a motor vehicle, and you choose to depreciate it by let's say 10%, that is your depreciation policy in line with, say, IAS12, property, plant, and equipment, for a category of asset called motor vehicle. That is the accounting policy. Based on your evaluation and judgment, that stands, no question. Now, but for tax purposes, we have a framework, that is Schedule 2 of CETA, that prescribe the initial allowance rate and the annual allowance rate for various categories of qualifying expenditure. So when it comes to motor vehicle, for example, it has an initial allowance of 50%, right? And an annual allowance of 25%. This is what it means for the first year that an entity puts the vehicle into use for tax purposes. It is allowed for it to make a calculation of the initial allowance of 50%, another 25% for annual allowance on that motor vehicle, and this calculation are the sums of the amount deductible towards arriving at the total or taxable profit of that entity. But now let's contrast it with accounting framework. Under the accounting policy, the entity is moving ahead with a 10% depreciation rate. So if you take a motor vehicle of 10 million, for example, 10% is going to give you, a 1 million naira, right? So after year one, you are going to have a carrying amount of 9 million. You get 4 million under the accounting framework. Fine, no question. That is your judgment, right? But under the tax framework says under Schedule 2 for motor vehicle, right, that you charge 50% initial allowance and under 25% for annual allowance. So let's make it simple. Let's start with the initial allowance. 50% of 10 million is going to give you 5 million.
5 million.
So from the tax framework, the tax written down value for the motor vehicle is going to be 10 million cost, less initial allowance of 5 million.
5 million.
You have 5 million tax written down value. I'm already putting on hold the annual allowance, right? I'm putting that on hold, right? If I'm to go further, you are going to have a reduced amount further as the tax written down value for that motor vehicle. But let's keep it simple. So the TWDV or the tax base, as it may be called, for the motor vehicle is 5 million. for under, for the purpose of the tax framework. Now, contrast it with accounting framework that has a carrying amount of 9 million after year one. So accounting framework has a 9 million naira carrying amount. The tax framework, we are simplifying our analysis by keeping the annual allowance on hold, right? The tax base is reading 5 million. What do you notice? A 9 million naira here under the accounting framework and a 5 million naira here under the tax framework. There's a difference. There's a difference, right? One is saying 5 million, one is saying 9 million. There is 4 million difference. So what is the issue? In computing the total profit of this entity, the depreciation, right, is going to be disallowed in place of the capital allowance that will be granted. So the tax authority disallows 1 million, which is the depreciation, and let us say grant 5 million. 5 million, which is your capital allowance. Recall I'm keeping the annual allowance on hold to simplify the explanation. So the tax authority is going to grant 5 million. What happens? You notice that following the principle of the tax framework, you are going to arrive at the total profit or total profit that is lower because more amount has been deducted from the accounting profit, more than if you were to stay with the 1 million that ought to have been deducted. In other words, rather than deducting 1 million, you have proceeded to deduct 5 million, so 4 million more. What we are saying about the fact that in the future, this is going to have an effect. Why is it so? In year one, or in the appropriate year of assessment, the tax authority has granted you additional 4 million naira deduction. So while you're carrying 9 million naira in your accounting record, intending to depreciate that 9 million for the remaining lifespan of that motor vehicle, what the tax authority has for you left is 5 million. Remember, the historical cost of that motor vehicle is 10 million. So the tax authority has granted you 5 million already. You're having 5 million naira outstanding. So in the future, the tax authority is going to allow you to deduct further a maximum of the residue, which is 5 million. But if you look at the accounting framework, you are having a carrying amount of 9 million. That means you are carrying an amount that is over and above the 5 million that will be granted by the tax authority. So in the future, subsequently, you are carrying a 4 million naira, that is 9 million minus 5. You are carrying a 4 million naira excess that is going to be disallowed in the future. Why? Because you have been granted that 4 million ahead in year one. So the future tax implication, not current, in the future, we are looking at the future. In the future, we intend to deduct 9 million cumulatively as depreciation. The tax authority is going to, forbid you from doing that, but granting only 5 million remaining. So that 4 million differential, which will be disallowed in the future, as at year one, mirrors the future tax consequence. And that future tax consequence is that 30%, let us assume, say, a large company, 30%, right, of 4 million is going to give us 1.2 million. 30% of 4 million is going to give 1.2 million. So as at year one, which is the reporting day, what deferred tax implies is that as at that year one, you have a 1.2 million deferred tax liability. Why is it a liability? In the future, your income tax obligation will increase by 1.2 million because when you try to depreciate 9 million in the future, only 5 million can fly. The 4 million excess of it is going to be disallowed in the future. It does not have a current effect now. It's going to have an effect in the future. And
That's
that
great.
tax effect in the future, 30% of that 4 million will give you 1.2 million. So as at this year one, the reporting date will say that is a deferred tax liability. It is not a current tax liability. It is not a current obligation. You are not bound to pay now. No, not at all. Rather, but because you've enjoyed the benefit now, so you are going to, it's going to reverse in the future because you are going to fulfill that obligation in the future when the time comes. That is the concept of deferred tax under IAS12. Just a simplified explanation.
They have been able to give us a deep insight into the two arms of the income taxes that we're talking about the current and the deferred taxes. Let me on this note tell our viewers that we have opened the blog for you to bring in your question for our guest for today, to do justice to it, and at the right time, trust, I will always bring up the question for our guest to do justice to. OJ, as we proceed, let me go a bit deeper and technical. Sincerely speaking, once we talk about this IAS, IFRS, name all those standards, it becomes technical. For people like us, that the only thing we understand is to talk, but we leave the technicality for you to tap from you. I
Okay.
proceed like this, going deeper by saying, can you share with us your understanding of permanent and temporary difference, especially in respect of amortization and impairment loss?
Okay, you see, under the current IAS12, we talk about temporary difference. In the illustration I just gave few seconds ago, you'll notice that the historical cost of the motor vehicle we use for our illustration was 10 million. That amount is not going to change. So long as an entity applies that motor vehicle in generating taxable profit, that 10 million is a qualifying expenditure for purpose of capital allowance. But the issue is the manner of prorating the use of that motor vehicle under the accounting framework is different from the way the same qualifying expenditure is being, in quote, consumed or prorated under the tax framework. So in the example one I gave, I said when you use 10% depreciation policy, 10% of 10 million is 1 million, giving you a carrying amount of 9 million at the end of year one. So let's say 50% of 10 million, right? Say initial allowance of the vehicle, 50% of 10 million is 5 million. 10 million less 5 million is going to give you a tax now value of 5 million. Now compare it. The accounting framework has a balance of 9 million. The tax framework has a tax now value of 5 million. There is a difference. What we are saying, that difference is temporary. Why is it temporary? In the future, it is the same total amount of 10 million that will be expensed in the accounting life cycle of that motor vehicle. It's going to be the same 10 million. But the approach of expensing it under the accounting framework is saying 1 million every year for 10 years. But under the tax framework, it is, maybe 5 million, to imply maybe 5 million, then another, maybe let us say 125,000. Now, let me explain for our audience. You see, the annual allowance is 25%. Initial allowance is 50%. 50% of 10 million is 5 million. So if we say the cost less the initial allowance, we have another 5 million, right? So that 5 million, spread it over 4 years. So the annual allowance, ignore the 10 naira, to be carried in the books, or 1 naira to be carried in the books when the item is going to disposed of. Let's ignore it. Annual allowance is 125,000, right, for the first year. And initial allowance is 5 million for the first year. 5 million plus 125,000 is going to give you 625,000. So for the tax framework, the tax now value effectively after year one is 10 million less 625,000. So it's 10 million less 6 million 125,000. That will give you 3 million 875,000. 3 million 875. So that will call the tax now value. What we are saying, the difference between the accounting framework and are temporary. As you move into year two, guess what? In year two, you are still going to charge another 1 million in your accounting framework for depreciation. But guess what? The tax authority will disallow that 1 million and grant you another 125. When you get to the end of year four, at the end of year four, the tax authority will have granted you 100% credit for that qualifying capital expenditure. Meaning at the end of the first 4 years of that motor vehicle, you will have expensed for tax purposes, right? Your qualifying capital expenditure incurred on that motor vehicle. It ends there because you've already taken the benefit. They've been deducted from your accounting profit in ascertaining your total taxable profit at the end of 4 years of operation. I'm assuming you have a profit scenario, not a loss scenario. But at the end of 4 years, something happens. Something is happening. At the end of 4 years, for accounting framework, you are going to have a 6 million naira carrying amount. Because you are doing a 1 million naira per year. After 4 years, you are going to have a 6 million naira carrying amount. So at that point, Now, what the framework is saying is that the entire 6 million naira remaining, which automatically after 4 years will still give rise to deferred tax liability, right? At that point, from year 5, year 6, year 7, up to year 10, for example, from year 5, 6, 7, 8, 9, up to year 10, anything we charge as depreciation will be disallowed. In other words, it is the same global 10 million that a capital allowance is granted on, but not in the pattern of your accounting framework. So the difference between both framework, we say, is a temporary difference. It's not a permanent difference. You just say somebody is charging 1 million every year. The other framework charge 6,125,000 in year 1. In year 2, you charge 125. You charge them, you charge 1,125,000. You charge them another 1 million in year 3, in year 4. So the kind amount are temporarily different. Ultimately, it is the same qualifying amount of 10 million that will eventually be expensed. So the scenario, the circumstance, that only show short-term disparity in the amount charged as depreciation or capital allowance, and in their resultant carrying amount and tax return value are called temporary difference. That is the concept of temporary difference. The difference will reverse. They will nil off over time, but maybe not in the short run. That is the concept of temporary difference.
Great.
And anything we deal with under deferred tax, it is from the angle of that temporary difference. And please, let our audience take note. When we say temporary difference, it means that the carrying amount we are comparing against a tax base or a tax return value. Now, but when we have unabsorbed capital allowance carried forward, for example, where we have unrelieved loss carried forward, these two items do not have carrying amount because they are not recognized in the accounting system. These are the provisions of our tax law. So unabsorbed capital allowance carried forward, for example, loss relief carried forward, they have tax basis, but they do not have carrying amount. So the totality of the items in which and on which deferred tax is ascertained from are items that give rise to temporary differences, items that are in form of capital allowance unabsorbed carry forward, and losses on relief carry forward. These are the three general sets of components that give rise to deferred tax, whether as a deferred tax asset or as a deferred tax liability.
Awesome. Great. And sincerely speaking, when I have technical topic like this, and I see people that take us to class and make me to have a refresher course, as if I'm just writing ICAN, it gives me that great opportunity to always listen to. And I want to just tell you, while you are giving those explanations, you've been able to do justice to the question that some of our audiences have raised. Fagbola from the Asian city and the brown roof of Ibadan have asked a question about the temporary difference, and that you have been able to do justice to. Also, Usman, who was talking about the deferred tax liability that you have also mentioned. While I await other questions from our audience, let me continue with the one that I have for you here. OJ, our global viewers would like to be further educated on the reporting of that deferred taxes and how it is presented in the financial statement.
Oh, thank you. Great. Like we know, any tax amount that leads to a reduction in the payment of future taxes is a deferred tax asset. Any tax amount that will lead to a reduction in future tax obligation or entity as at the reporting date is a deferred tax asset. Whereas any tax amount that will lead to increase in the future tax obligation of our entity as at the reporting date is a deferred tax liability. As we had explained, they are not current taxes, they are deferred taxes. So how are they presented in the financial statement? How are they represented? Yes, let's take Amanda. First of all, let's go to the statement of financial position. When you have, there are different items an entity will have. You can have a motor vehicle, you can have building, you can have equipment, you can have computer, you can have this and that. Deferred tax is computed separately for each item and for each class of item presented in the statement of financial position. So this is the point. A deferred tax asset may arise on a motor vehicle. A deferred tax liability may arise on a building. A deferred tax liability may arise on intangible assets. A deferred tax asset may arise on biological assets, whichever you want to view it. Now, so we have a scenario where there could be deferred tax asset, deferred tax liability, deferred tax asset, deferred tax liability on different items. For an entity, it is the net deferred tax position that is presented in the statement of financial position. In other words, where some items give rise to deferred tax liability, some deferred tax asset, you have to net them. The net balance is what is presented in the statement of financial position. Where it is a deferred tax asset, of course, it is presented under assets. Where the deferred tax liability, it is presented under deferred tax liability. Where an entity presents a current and non-current presentation of items in the statement of financial position, what IAS1 says is that every amount about deferred tax liability should be presented under non-current liability. Every amount about net deferred tax assets should be presented under non-current assets. In summary, deferred tax net balance is not presented under any current category. So in the face of statement of financial position, deferred tax net balance is presented either as a non-current asset or as a non-current liability in the individual financial statement of an entity. But the same is not so for a consolidated statement of financial position. When you prepare a consolidated statement of financial position, it is possible that a parent company has two subsidiaries. For example, a subsidiary A and a subsidiary B, in addition to his own affair as a parent entity. This is the point. There may be a net deferred tax asset position in the book of the parents. There may be a net deferred tax liability position in the book of one of the subsidiaries. So two contrasting positions. In the financial of the parent is a net deferred tax asset. In the financial of one of the subsidiaries is a net deferred tax liability. So how is it presented in the consolidated statement of financial position? So this is it. So the position of a parent and a subsidiary, where they have opposing deferred tax balances, are presented separately. In other words, in the consolidated statement of financial position, the net deferred tax asset balance is presented under assets, and the net deferred tax liability balance for the subsidiary is presented under non-current liability. So where one is an asset for a parent, you present it separately under asset in the consolidated statement of financial position. When the other is a deferred tax liability, you present it under non-current liability. You do not do netting in a consolidated statement of financial position. Why? In Nigeria, our tax law does not recognize group tax filing, and there's no group claiming of taxes. So netting is impossible under our group accounts in our tax law. There is no consolidated tax filing in Nigeria. So it has to be reflected in line with the provision of the law. Then lastly on this, when it comes to the statement of comprehensive income, statement of profit or loss and other comprehensive income, you know, when you follow the flow and get to a point, what you used to call PBT those days, profit before tax, right? Now, the next line item will be tax expense. So in that tax expense, it is a summation or the netting of your deferred tax movement for a period and your current tax movement for that period. Recall we had illustrated the meaning of current tax when we said the CIT you have to pay, the PPT you have to pay, the PIT, the CGT, the Information Technology Development Levy, the Nigerian Police Trust Fund Levy. Those categories of taxes are current when the obligation had to be met within 12 months from the reporting date. So the movement in your current tax item and the movement in your deferred tax item, that movement that arises within that period are summed or netted and presented as a one-line item called tax expense or tax credit or tax income, as the case may be, in that place, in that line item. So if anybody goes to the statement of comprehensive income, just know that when you go to the tax expense, it's a summation or netting of the current tax movement and the deferred tax. That is what we present as one item. If you go to the OCI section, as the case may be, other comprehensive income, there are two options. Where there are tax implication for the income or expense or gain or loss item in the OCI, you may choose to present tax expense in the face of that OCI line item, or you may choose to present the item net of the income tax amount. For example, if a revelation surplus is 2 million, for example, and the tax expense is 1 million, is 500,000, for example, that will mean two options. You may present your revelation surplus 2 million, present the associated tax expense 500,000 to have a net amount of 1.5, then you proceed. 1.5. That is option one. Option two is to present it net. In other words, you just write revelation surplus net of income tax and you present 1.5 million. These are the ways everything about whether they are deferred or current are presented in the face of financial statements.
Great. This is awesome. And like I can read from our audience, you are demystifying this IAS12. Sincerely speaking, if ICAN or any professional body should bring an exam for me on this IAS12, OJ, I promise you with the explanation, I promise you 97 over 100 because you are really breaking it down, though it's very technical. While I await a question from my audience, let me continue to ask this question. It's in line with IAS, but I want to bring in, since we are talking about income, considering the visible collapse and drop in the activity of the strategic, domestic, industrial, and commercial sectors due to high energy and operating costs, what will you say is the effect on the disposable income of an average Nigerian in line with IAS12? Remember, we're talking about income taxes and we're talking about income, the average disposable income of a Nigerian.
Okay, let me take you from the economic or fiscal, let me take you from the microeconomic analysis. Microeconomic analysis for an individual, because that's, the individual now. Of course, rising cost, energy cost, any cost whatsoever, any cost, whether it's energy, whether it's rental, food, and all of that. Of course, all of these go further to reduce this disposable income of an average Nigerian. That is it. So if you look at the inflation we've been battling with, inflation has not been friendly. I mean, anyway, maybe so with other parts of the world as well. Inflation is there. This inflation represents various rising costs across various basic items. We are not thinking about luxury items. So the reality that everybody knows is that it goes further to impoverish an average Nigerian. That is the reality. Yeah, that's the reality. So from the current tax point of view, yes, even if you give concessionary tax rates, so you said, you know what, irrespective of your income, we are going to calculate your income liability as an individual at just 7%. We are not moving to 11. We are not moving to 15 or 19 or 21 at 7%. That is fine. The question is, what is the general price level increase over a period of time? If you are paying someone 30,000 naira in 2023, is it the same with the 30,000 naira paid that person in 2021? No, of course, it's not the same.
Yeah.
The real value, we're not talking about the nominal income, the real income in real terms. When you factor in the impact of inflation, generally, the average Nigerian is impoverished further by the occurrence of inflation, by the challenges of little to no change in salary within the past 12 to 24 months. So that is the harsh economic reality. So keeping the reporting stuff aside and looking at the microeconomics for a typical Nigerian, right? So the inflation, non-increase in salary, even cut down in salary as occasioned by COVID. We remember COVID just left us in 2020, right? 2021 was an interlude, then 2022, then we have the Russian, Ukraine and all of the impact on energy cost, we have these security things. So all of these things are an amalgam of issues that have pushed pricing up. Some people have lost their job. Some have had to deal with salary cuts because the company will not want to lay off their, its workers. So by and large, we are having a threatened downturn. We are having a threatening rate in the disposable income of an average Nigerian who is unable to alter his income flow within the 9 to 5 or 8 to 5 working environment here in Nigeria.
Awesome and great. And that is a great explanation. Sincerely speaking, it's not been an interesting time for an average Nigerian. I can speak to it that it's not just those of us here in Nigeria, across the globe. It's been a challenging time when he talked about income for several people. The high cost of living and high cost of everything is putting the little income in our hands, making the purchasing power to be very, very low. As we proceed, let me quickly take Ismail question. He's asking that what are the implications of IAS12 on receivables and payables, considering the deferred profit associated to that?
Okay, thank you. Let's take it one after the other. Let's start with receivables, say trade receivables. The question is the trade receivable in line with IFRS 9. In line with IFRS 9, by default, there must be certain element of impairment on trade receivable. Therefore, what you have as the current amount for trade receivable is the gross trade receivable or gross receivable less impairment as at a given date. For tax purposes, impairment that does not constitute a bad debt, I want that to be taken note of. Impairment that does not constitute a bad debt is not a deductible expense or is not an allowable expense. In other words, when you charge your impairment, yes, you are following the total credit loss model in IFRS 9 to measure your impairment. The tax authority is going to disallow that in computing your total or taxable profit because that impairment is not a crystallized bad debt. That is the impact. So when it is disallowed in the computation, what happens? The entity that has done the impairment suffers the effect by paying more income tax in the current period. Why is this so? Because the impairment deduction has been added back, right? And its income tax is slammed on that total profit. But this is the reality. In the future, if such impairment crystallizes, when the impairment becomes an actual bad debt, CETA provides that bad debts that have been certified to be bad are allowable deduction. So this is the point. Where you have a trade receivable that is a current amount after netting impairment, the question is, the impairment recognized, is it as a result of bad debts or is it just provisional? Right? Where it is provisional, following the certain concept of ECL measurement model, there is going to be a deferred tax implication. Why is it so? The current amount is net of impairment that will be disallowed or that has been disallowed, but the tax base remains the gross receivable. So the meaning is this: the tax authority is going to disallow the impairment, but in the future, when that impairment or if the impairment translates into a bad debt, it becomes deductible in the future. Therefore, as at a reporting date, that impairment is disallowed. The entity suffers the current tax implication, but the entity is required to recognize a deferred tax asset. Why is it a deferred tax asset? Because in the future, when the impairment will crystallize as a bad debt in the future, it will become deductible, thereby reducing the future taxable or total profit of that entity. So as at that present day, the entity recognizes a deferred tax asset on an impairment that has been disallowed, which was provisional. So and how it is calculated, the tax base is the gross receivable amount less the carrying amount. That will establish the temporary difference we spoke about. Temporary because in the future, the real effect will take place.
That is great.
About trade receivable. Yes.
Yeah, that is great. And I want to believe that Eunice has picked up that relating So, receivable and payable as referred to the father prophet. Sincerely speaking, it's been a wonderful and insightful time with O.J. Samuel as he keeps breaking down everything that has to do with IAS12. Sam, I just promised you, let them set question on IAS12. If I don't give you 97 over 100, you're taking me back to class of those days when I was lecturing. And we can see justice to that in some of the books that you have written. We'll proceed because I can look at the tick of the time that it's going. But I want to take this question as relate the current Finance Act that we have annually. Talking about our dear country, Nigeria, are there tax implication of the Finance Act on the current or deferred tax reporting in Nigeria?
Yeah, thank you, Mr. Kwande. Thank you so much. There are lots of implications from 2019 till date to the 2021 Finance Act. It has remained that we have three categories of companies for the purposes of income taxation in Nigeria. We have the small company, we have the medium-sized company, and we have the large company. The small companies with annual gross turnover annually of not more than 25 million or 25 million and below, right? This category of entity are exempted from company income tax and from tertiary education tax. For the medium-sized company, the tax rate is at 20%, and for the large company, the tax rate is at 30%. So these are the implications. If you are a small company in Nigeria and you are just starting out, meaning a company starting from 2020, when Finance Act 2019 became applicable from February 1, 2020, for all new companies that began from February 1, 2020 till date, that still fall within the small company threshold, they are not required to pay income taxes. Therefore, they are not required to recognize income taxes in their financial statements. I repeat, they are not required to recognize income taxes in their financial statements, whether the income taxes are by way of current tax or deferred tax. Why? Because they're exempted from profit tax. That is the number one implication. What about small companies that used to exist before they were categorized small from February 1, 2020? They used to exist before the advent of Finance Act 2019. So from the year 2020, February 1, maybe their turnover became, say, their turnover is currently 12 million, 13 million, and all that. Automatically, they were either taxed at 30%, but they are now to be taxed at, they are now not to be taxed. What happened to the deferred tax balances they've been carrying before the advent of Finance Act? For such company, so long as the turnover threshold or gross income threshold, total income threshold, is not close to 25 million, such companies are required to derecognize any deferred tax balances they are carrying in their books. Derecognize, because the concept of deferred tax is that in the future, it will increase or reduce. But now, in the case of an entity that is no longer subject to profit tax. So any deferred tax balances you had carried over into 2020, and your turnover is not getting close to 25 million, such entities are required to derecognize, take it out of the books, meaning write it off to your retained earnings. That is the life and practical picture in that regard for small companies. So we've done the analysis of the ones that started in 2020. We say do not recognize anything current or deferred in that aspect. That we've gone to the one that used to exist before the Finance Act. We would say if your turnover is still far away for the 25 million threshold, recognize any deferred tax balances you are carrying, right? Now, is it possible to still see current tax balances in their book of this category? It is possible. There could be a tax audit, and the tax audit has been carried for, it took a view of the last 4 years, for example, and they came up with you underpaid this in 2018, you underpaid this in 2017, you underpaid that. What happens? Of course, you are going to have a current tax payable, not because you are subject to tax under the current tax law, but as a result of the consequence of the tax audit that has shown up underpayment or under provisions in the past. Quickly, for medium-sized companies, What has changed is only the tax rate. For those companies that are making turnover of above 25 million, right, but less than 100 million, or no more than 100 million, the tax rate that to use in computing whether they're current or deferred taxes is now 20%, no longer 30%. So it is possible that as of February 1, 2020, you had used 30% to arrive at the deferred tax balances or the current tax balances, as the case may be. What you have to do subsequently is to only use 20% subsequently. Don't need to try to go and recompute, because under the tax law, the new law becomes applicable from February 2020 onwards. Just use 20% going forward for any calculation you are to make. So that is where we are about that. We cannot speak on the Finance Bill 2022, the issue of the gas flaring for certain companies, so we don't know how that will go. On it becomes an act, we'll know what the position of the tax law is, and then to simulate the current and deferred tax implication on this. Then for the large companies, 30%, everything remains the same.
Great, great, great. I must tell you, OJ, you are actually digging it deep and deep, and we now have the different thing. But time will not be my friend. Each time I try to give a deeper insight into some of the topic that we are having. But as we gradually wind up the program for today, in less than 2 minutes, I just want to ask this question. Can you give us an understanding if there is any nexus in the approach of the income tax under IAS and the IFRS? Is there any nexus between them?
It's just the same thing. Under IFRS,
Okay.
right? Whether a standard is called IAS, whether a standard is called IFRS, including the IFRIC, the interpretations, or the SIC interpretation, all of them together are called IFRS. That is the position of IAS1 and IAS8. So all of them are called IFRS. So what we have is IAS12 income taxes, and that is the standard we call IFRS. So that is what we have. In the Nigerian scenario, it has been supplanted. We used to have SS12 accounting for deferred taxes, which was replaced by SAS19 accounting for income taxes. But because we have adopted IFRS, all of those provisions cease to exist or cease to apply to our reporting jurisdiction. So the IAS12 income taxes is the one we refer to when we talk about either IAS or IFRS. Irrespective of the name, they are all called IFRS in line with the provision of IAS8 and IAS1 on the name of the standards. So they are the same.
Beautiful, beautiful, beautiful. And sincerely speaking, we are winding up. And it's been a very insightful time on ICAN on Air this day. But before I go, and this is in closing, our institute is always open to ideas that will positively enhance the advanced growth of our members, the accounting profession, and the Nigerian business environment. In this first week, because we are still in the first week, this is the second edition of ICAN on Air. We want to seek your advice or suggestion to give to our members, the Institute, on this discourse of today, IAS12, which border around income taxes.
Thank you so much. You see, when you look at, sometimes we don't use this Excel template and churn out stuff. If someone is looking at your reporting of income tax information in your financial, there's an investigative part of accounting. No matter what you've done, when we pick the financial of any entity, I use the word any entity, we can tell what you computed as your income tax liability in your schedule. And we can tell whether your computation were not consistent, or were wrong, or were falter, or were manipulated. In fact, that is the place for those who have advanced knowledge of this concept. When we talk about reconciliation of applicable tax rates to the average tax rate, for anyone deep in it, when you pick any financial, you can actually pinpoint what the preparer or the auditor that superintended the preparation and gave a clean bill of health has done in computing or in arriving in the amount disclosed. Therefore, my advice would be that members who are either in industry, in practice as consultant, in advisory, and should take should take care and be detailed and be methodical in doing what is prescribed in line with the standard. Because there's a way and network can pick up a financial you've audited and come up with something which will actually show that the preparer of the financial has done something contrary or not in tandem or something unethical in the way tax information should be measured and presented in financial statement. And that will run foul of the provision of FRC when it comes to financial reporting guidelines that are sanctionable depending on the category of errors or missteps that must have been committed. Thank you.
Sincerely speaking, it's been an insightful time with you, O.J. Samuel, my great brother and friend, doing justice to it. And like I tell you, go and set question on IAS12. Trust is 97 over 100 because I know that the markers do not like to give 100 over 100. It's to tell you that you've done justice to the topic today, and we appreciate you sharing your evening with us on ICAN on Air. We want to believe that when next we call on you, you will definitely avail us your time to share the knowledge with us. And on that note also, I want to appreciate all our guests who are connected from the north, from the south, from the west, east, everywhere, the south. I've seen all of you connected today. Like I promised you at the beginning of the year, this year is going to be educative, insightful, and giving you guidance as you progress. But let me quickly roll out this very fast announcement. As we are all aware, it's a new year. New year is here. Have you paid your subscription? You know that is very key and strategic to the growth of our institute. If you are an associate member, I'm sure you've received the demand notice. You have all the steps to pay. You don't need to visit anywhere. Go online, make your payment. As associate, 17,500. As a fellow, which is the highest cadre of our institute, you have 32,500 to pay. Let the subscription start rolling in. I'm sure you and I understand there are benefits that we all have in case of any eventuality that the institute has made provision for. But it is only for the financial members. So I encourage you to start dishing in some of your. If you have not gotten the demand notice, please contact the finance department. It's readily available for you so that the institute can move on. And I also want to state that all those that are due for fellowship conferment, please do not hesitate to check up on the website and get registered. The program will be coming up very shortly. And you know, to be called an FCA, let me use the street language, it's no be yamo. I'm proud to be one. And on that note, I'll be bringing it to a wrap today. Until I see you next week, Tuesday, I remain your host. And on behalf of the editorial board, Olusesan Okwade, FCA. Till I see you on Tuesday, bye for now.